Have you ever logged into your banking app only to be greeted by a friendly pop-up asking you to update your annual income so the bank can serve you better? It feels like a routine request, almost like a customer service courtesy. But before you type in that new number, you need to understand the hidden mechanics behind that screen. Banks are not asking because they want to help you manage your budget. They are gathering ammunition. In the world of modern finance, your income is not just a number. It is a high-value data point that triggers complex algorithms designed to maximize institutional profit at your expense. The moment you submit that information, a silent process begins behind the scenes. These algorithms use your income to categorize you into specific risk and profit brackets that dictate exactly how you will be treated. This data determines the interest rates you are offered, the credit limits you receive, and even the intensity of the marketing campaigns targeted at your inbox. Most people do not realize that once you hand over this data, you lose control over how it is weaponized. Your high income might actually signal to a bank that you are less price sensitive, leading them to charge you higher fees simply because their models suggest you can afford them without complaining. The most critical thing to remember is that in many jurisdictions, providing this updated information for an existing account is entirely voluntary. There is often no law or regulation mandating that a credit card company must have your current salary on file to keep your account active. Banks deliberately blur the line between a legal requirement and a polite request because they know that an informed customer is a less profitable one. They want you to feel an obligation to comply so they can continue to optimize their bottom line using your personal details. If you want to see exactly how these hidden calculations impact your wallet and how to reclaim your financial privacy, comment the number 1 below to see the full breakdown and finish the video. Once you realize that these friendly requests are actually data collection tools, you can begin to see the first major trap they set for you: the psychological lure of the high credit limit. On the surface, receiving a massive credit limit feels like a badge of honor. It suggests that the bank trusts you and recognizes your financial success. But behind that curtain, the reality is far more calculated. Banks use your reported income to determine exactly how much credit to extend, and higher income generally leads to higher limits. This might seem like a benefit, but in many cases, it is a strategic move designed to encourage higher spending and deeper debt. The math is simple but devastating. Someone earning $150,000 can theoretically handle more debt than someone earning $50,000. However, banks know that customers with higher limits tend to carry higher monthly balances. A $30,000 limit is not just a safety net. It is an invitation to spend more than you would if your limit were capped at $5,000. The bank is not rewarding your success. Instead, they are giving you more rope because they know that consumers with more rope are statistically more likely to find themselves paying high interest on large balances over a long period. This is where the relationship between your income and your wallet becomes truly asymmetrical. By volunteering your newest salary figure, you are essentially asking the bank to expand your capacity for debt. This enables a lifestyle where your expenses can easily rise to meet your new income level, leaving you with less real savings and more financial vulnerability. Banks are profit-maximizing entities, and they understand that a customer who carries a large balance is worth far more to their bottom line than a customer who pays in full every month. When you refuse to update that income field, you are choosing to maintain a stable financial boundary, forcing the bank to judge you on your actual behavior rather than your theoretical capacity to pay back more debt. As you begin to see that a high credit limit is often a trap designed to encourage debt, you must confront an even more disturbing reality: how your income data is weaponized to set your interest rates. Most people assume that a higher salary automatically leads to lower interest rates because higher earners are seen as lower-risk borrowers. However, the reality within the banking industry is far more cynical. Banks frequently utilize a strategy known as ability to pay pricing. Instead of rewarding your financial success with better terms, they use high-income signals to identify customers who are less price-sensitive. The logic behind the algorithm is simple. If you earn $200,000 a year, you are statistically less likely to shop around for a better rate or notice a small increase in your annual percentage rate. The bank calculates that you can afford to pay more, so they charge you more. It is not about your risk level. It is about how much they can get away with. Research has shown that affluent customers sometimes receive worse terms than they should, because banks correctly predict that these individuals value convenience over the effort of switching providers. Your success becomes a signal to the bank that they can extract higher margins from your accounts without losing your business. By withholding these income updates, you disrupt this predatory calculation. You force the bank to rely on your actual behavioral data, such as your consistent payment history and low credit utilization, rather than an arbitrary salary figure. When the algorithm lacks a fresh income update, it has to treat you based on how you actually manage your money, putting you on a more equal footing. Before we move to the next secret, I want you to check your last bank statement right now. If your interest rate seems high despite your good income, you might already be a victim of this hidden pricing strategy. Once you realize that your interest rates might be higher simply because the bank knows you can afford them, you start to see the banking relationship for what it truly is, a constant battle for your data. This brings us to the next stage of their strategy, which is aggressive targeted marketing. The moment you reveal an increase in your income, you trigger a fundamental shift in how the bank communicates with you. What was once a peaceful and quiet banking relationship quickly transforms into a relentless sales campaign designed to extract every possible dollar from your new financial status. By updating your salary, you are essentially categorizing yourself into a specific prestige bracket. Suddenly, your banking portal becomes an obstacle course of targeted upsells. You are flooded with offers for premium cards with $500 annual fees, personal loans you never asked for, and complex insurance packages you don't need. These are not general advertisements. They are high-precision strikes, calibrated to your exact income level. The algorithm knows that someone earning $180,000 is statistically more likely to say yes to a high-fee status card than someone earning $60,000. Your login screen is no longer a tool for managing your money. It is a digital billboard optimized for your wallet. On the other end of the spectrum, lower income data triggers a different but equally dangerous set of predatory products, such as high-interest balance transfers and loans with hidden fees. This is why the concept of data minimization is so critical. By providing only what is legally required and refusing to volunteer optional income updates, you prevent these algorithms from waking up. You stop the bank from resetting the clock on their aggressive acquisition tactics. When you keep your information private, you remain a low-profile customer, allowing you to fly under the radar of their most expensive marketing traps. Flying under the radar isn't just about avoiding annoying advertisements. It is about protecting yourself from the long-term memory of the banking system. You must understand that any data you provide to a financial institution has an incredibly long half-life. An income figure you entered 5 years ago doesn't just disappear once your application is approved. It sits in your permanent file, quietly influencing how you are treated during internal portfolio reviews, or, more importantly, during times of economic uncertainty. When the economy weakens, banks look at these numbers to decide whose credit limits to slash or which accounts to close to minimize their own risk. This reveals a massive information asymmetry in your relationship with your bank. The institution already knows your spending patterns, your debt levels, and your daily financial habits. They use sophisticated algorithms to sort you into risk or profit categories that you will never see. Meanwhile, you remain completely blind to their internal decision-making process. You don't know the exact formula they use to determine your worthiness or your profitability. By volunteering even more data, like your current salary, you are only increasing this imbalance of power. You are handing them the final piece of the puzzle they need to optimize their profit at your expense. By declining to provide optional income updates, you're taking a small but powerful step toward leveling the playing field. You are forcing the bank to judge you based on your actual, observable actions, your consistent on-time payments, your low credit utilization, and your long-term account stability, rather than a self-reported number that can be weaponized against you in ways you can't foresee. Your actions should be your profile, not your salary. This approach shifts the focus back to your character as a borrower, ensuring that the bank treats you as a responsible individual rather than just another data point in a predatory algorithm. By forcing the bank to judge you based on your actual behavior rather than a self-reported number, you reclaim a level of financial privacy that most people unknowingly surrender. This leads us to the final and most important lesson. You must be intentional, not reflexive. In a world that constantly demands your data, the most powerful thing you can do is pause and ask if providing that information actually serves your interests or theirs. While income verification is a legal necessity for things like mortgages or initial credit applications, the periodic requests on your existing accounts are almost always optional. You need to understand the clear distinction between lying and declining to volunteer. Providing false information on a credit application is fraud. It is illegal and genuinely wrong. However, choosing not to update your income when prompted by a pop-up is not deception. It is privacy. You are under no obligation to help a bank calibrate its algorithms to extract more profit from you. If you specifically want a higher credit limit to improve your utilization ratio, then by all means, update your income. But if you are satisfied with your current terms and want to avoid aggressive marketing and predatory pricing, the best move is to simply close that window and move on. The ultimate strategy is data minimization. By sharing only what is legally required, you protect your financial future from unforeseen shifts in banking policy or economic downturns. You are trading a small amount of convenience for a massive increase in personal security and peace of mind. Your financial life should be built on your responsible actions, not on how much ammunition you provide to institutional models. If you want to keep learning how to protect your wealth and master the hidden rules of the financial world, make sure to subscribe to the channel and hit that notification bell. We have much more to share on how to stay one step ahead of the system, and you will not want to miss our next deep dive. See you in the next video.